Good afternoon, everyone. Welcome to the 2018 Market Outlook. We're just going to wait a couple more seconds, let a few more people log in, and we'll get started. Okay, welcome. We're going to get started. Welcome to our first quarterly market update. I'm Marianella Collado, and I am here with Matt Sainholz, who's going to lead most of the discussion on the market update as our in-house CFA and portfolio manager. And we have Ben Tobias here with us, so we hope to make this a bit conversational to keep you all engaged. So that's it. We'll kick it off. Matt?
Sure. Hi. Good afternoon, everybody. Welcome to our quarterly webinar here this afternoon. Before we get jump into what's been going on in the recent market turmoil here, we wanted to just outline that this is going to be a high-level overview of what happened in 2017 and where we are today in the markets, and a bit of a forecast for 2018. Of course, your unique situation and your unique circumstances are something that we would like to work with you on achieving your goals. So what we described here today, anything that you might want to have a deeper dive on, please contact us, and we'd be happy to review some of our thoughts on these ideas and how it affects your personal situation. Today's agenda will basically be giving a quick high-level overview of our Tobias Financial Advisors investment process and some of the considerations we make as we build our portfolios to help our clients achieve their goals. Then we'll be diving into what happened in 2017, where we've come from, and then I'd like to spend some time in 2018 as to what we just saw in the recent market. And we're going to be going through some of those twists and turns that we've experienced in the past few days and the reasons why that may have occurred. We'll also be tackling some hot topics that we're getting from our clients, such as what about interest rates. We'll talk a little bit about Bitcoin today. So we want to try to give a broad overview of some of the major financial themes in the markets.
Good point, Matt. And I think, we try to take into account some of our frequently asked questions so that we can make these as interesting and relevant for all of you. So just keep that in mind, too. Feel free to send us questions. There is a section where you can submit questions. So feel free to, put your questions there. We'll try to either address them as we're going along or at the end. But certainly if you want to talk a little bit more in depth, like Matt said, we can speak to you afterwards. So who we are, Tobias Financial Advisors, most of you already know, we were established by Mr. Tobias himself in 1980. So we're proud to say we're nearing our 40-year anniversary. Big party for that. We'll have to get to work on that. So we have, just as an update, we manage over $325 million in assets for families like yourselves on the line. Their business 401ks. So kind of this is more of a generational kind of family wealth planning approach. So it's for over 150 clients. We have now grown to a team of 10 members here in the office. So the next thing we're going to walk you through is, in general, when we start working with you, one of the main things is we start with the goal, kind of where are we trying to get, what is the goal that we're trying to achieve, and then as financial advisors and planners, our job is to make sure that we implement the right tools and use the right vehicles to get you where you need to go. So it's understanding, your level of tolerance, what it is we're looking to achieve during retirement or whatever the goal that we're planning for. documenting that policy or that approach and making sure that in times of volatility, such as this week, that we use that opportunity to revisit what were those goals that we put in place when we weren't emotional, when the markets weren't kind of doing a roller coaster movement. So that investment policy statement becomes sort of like a critical go-to document for us to reestablish, what the approach was.
It's actually very important in times like these to go back and refer to it as opposed to letting your emotions take charge. Emotions is the worst thing that could happen to an investor.
So some of the investment considerations as we're putting together not only your investment policy, but then how we actually construct the portfolio. We have some just major themes that we're trying to accomplish. Most of it comes down to this. We try to control what we can control. We know that markets are mostly unpredictable, and we want to try to harness that unpredictability as best as we can for your benefit. So what we try to do is reduce expenses, reduce trading costs, reduce administrative fees with the custodians that we choose. We want to diversify your portfolio across the globe. We want to think long term, and most importantly, we want to maintain our targeted asset allocation, and we want to make sure that we are not chasing market returns or making decisions in the portfolio that aren't rooted in either academia or that are just something that that's just kind of off the cuff on how we're feeling that day. You've heard Ben just mentioned, which is a great point. We don't want to get emotions involved in our investing, so we want to stay disciplined as well. So what happened in 2017? Some of the highlights. This is a great chart of just some headlines that we've seen over the past 12 months, dating back to 2017. And it was a coordinated global growth positive story for equity markets around the world. Thinking back to just after the election and when Donald Trump was inaugurated, it was a lot of uncertainty. But since then, it has been almost straight up, and we'll be reviewing some of the actual numbers here. But we put this chart up here is to say that no matter one headline, not one headline affects the market returns. There's headlines here that are both positive and negative, and if you just take that one newspaper clip or that one article that you see on the web and not think about the bigger picture, that could lead to mistakes in your investing world.
And I think, Matt, just, some of the ways that some economists are describing this is that 2017 presented that perfect background or that backdrop to create this sort of growth and expansion because of economic conditions, not only in the U.S. but globally. So this is kind of going back to fundamentals.
And interestingly, when you talk about international versus domestic, international obviously did very well last year, and even with the volatility of this past week, it is actually performing better than the U.S. markets, even with the downturn that we've just seen.
Right. So this is right into this slide, Ben, as you're pointing out, that looking across, these are annual returns for different major asset classes, and what happened in 2017, you'll notice that emerging market stocks were up 37% compared to the broad-based U.S. markets at 21%. There's also even the bond markets were up as well. So as you see, 6 green arrows across the board. There was very positive years in both bonds and the equity markets around the globe in 2017, and we'll kind of explain that a little bit more as we go through the program.
So on this chart, what this shows me, man, just correct me if I'm wrong, is when we're looking at client portfolios every 2 weeks to see if there's a need to rebalance, going back and staying focused to that target, you have almost a perfect, straight up situation where all the asset classes are moving in the same direction. This would be a case where we wouldn't need to make trades just for the sake of trading because the whole portfolio is kind of moving up in the same direction.
It's kind of reminiscent of 1999, where the markets were all up, and we actually had clients during that particular year who had no rebalancing for the entire year.
Yeah. So it was a pretty smooth ride. And this is a chart that we like to look at just to showing annual volatility and just to show what kind of a smooth ride it was. I'll try to explain this chart. The red numbers are on an annual basis for that calendar year, the biggest drawdown in that particular year. And so we saw in 2017, the worst drawdown for the markets, the U.S. markets, is based upon the S&P 500, was -3. And so this just was like a smooth ride, not a lot of ups and downs, not a lot of volatility like we've been seeing in the last week. On average, over the past 38 years, the average drop in intra-year is about 14%. So on average, we expect what's happened in the last week, these ups and downs, market gyrations. We've kind of were spoiled, I would say, in 2017 on having such a smooth ride and not seeing some of the ups and downs. And now we're starting to see that again.
It's normal.
It's normal, and we'll talk a little bit more when we get to that slide, but it really just presents an opportunity, which we'll get into in a little bit. When you have this volatility, it's really an opportunity to do quite a couple of things within the portfolio.
So just reviewing 2017 returns, we'll go through these rather quickly just to jump on to the more of the 2018 outlook. But in 2017, this chart was provided by Dimensional Fund Advisors. We have, you see that in the U.S., looking at the different types, the U.S. market-wide was up 21%, but of that, the growth stocks did better than the value stocks in 2017. Large growth did 30% in 2017, whereas large value did about 14%. So there was a large disparity between growth and value, and you see that in different years. So in other years, value will be back on top, and that's just something that was unique to 2017, and the fact that the growth part of the market outpaced the value.
And we'll get into a little bit kind of historically and what we think the trend is going to be going forward with respect to value versus growth, because I know that's a question that has come up quite often with our clients in terms of what portfolios did relative to the overall market, which was led by growth in 2017.
International developed stocks, these are the indices and mutual funds that invest in developed countries, Japan, France, Germany, those types of more established economies. So those did very well, better than the U.S. actually when looked upon from a market, across the market. So large companies, international, did 24%, and small cap companies, international, developed at 31%. I'll just draw to the top right chart here a little bit. The U.S. dollar was down in 2017, and that actually aided and supported our investment returns we see here in America. Weaker dollar leads to better price appreciation for some foreign investments. So, emerging markets, the growth was incredible. We have across the board, we had 37% returns in emerging markets, and we have in our portfolios. This is kind of why this year we have had and going in the previous years as well, we have a diversified global allocation. Certain times the U.S. will do better, otherwise other times international emerging markets do better. Both are very positive this year, and we will talk about that as far as our 2018 outlook coming up.
And I think this is almost that kind of basic saying of not putting all your eggs in one basket, and this is why we spread that to just not be all U.S., because you're going to have moments where there are headlines in the U.S. that affect markets, but it's not going to be global. So this whole concept of kind of spreading that portfolio globally, it becomes important in the long run.
Right, and we spread it globally and in a broad fashion, as you can kind of see here. This is always kind of a fun chart to look at to see which of the countries in developed markets and emerging markets what kind of returns they had, and it just goes to show you that it's a hard game to pick individual countries, and then kind of correlate that to individual companies. Apple versus Alphabet or Google. Those are hard to pick, just like as you would hard to pick between Canada and Austria. Who would have thought Austria up 51%? And it goes into that all eggs in one basket diversified approach. And the fixed income world, so the bonds, the more conservative piece of portfolios generally will have also had positive returns in 2017, and you're looking at the yield curve here, which is this dark line, comparing the dark line of 2016 to the light blue line of 2017. So what happens here is, as a reminder, is kind of an inverse relationship between interest rates and the price of bonds and the returns of bonds. So when the rates go down, value goes up. And you saw that on the long end of the interest rate curve here. The 30-year U.S. Treasury curve actually went down. So when you look at this chart here, you're looking at longer-term U.S. government bonds doing 8% last year in 2017. We're starting to see that trend. We have seen that trend reverse already here in the first part of the year in 2018. So in 2017, being in longer duration type of bonds, the longer dated bonds actually helped you. We are going to be of the opinion that we want to keep to the short end of the curve and shorter maturities for 2018, because as we see rising rates happen, that long-term bond, those returns won't look so pretty when the rates start to increase and have increased so far today.
And that's one of the reasons why the market has been so volatile in these last few days. We've had earnings reports and employment reports, all very good. So we have the good news on one side, but it kind of indicates that the Federal Reserve is going to be raising interest rates maybe sooner and faster than otherwise thought because of the fear of inflation. And that's one thing they want to keep down. So, with the good news comes the bad news.
So that was a quick tour of 2017 returns and, kind of where we've been. And we're going to now kind of move forward into where we think we are and where we think we're going as we go through 2018. So this is a chart of some leading economic indicators. And all we really want to get across here really is the underlying economic indicators are positive, as Ben just mentioned. This leading economic indicator index shows kind of a combination of unemployment and consumer sentiment. And what's happening is that the economy is growing. The economy continues to grow. We're starting to see on an annual basis what we've previously seen around 2% GDP growth. We're seeing forecasts that maybe in the 3 to 4% range. So we're seeing the underlying economy have some confidence and some growth.
This feels very different from what happened in 2008. There's been some parallels discussed. But if you remember, in 2008, we already knew about the real estate bubble. Things were already happening in that area. The economy was already going down. At this point in time, I think the volatility that we've had right now is solely a result of how fast the market went up. It got a little bit ahead of itself, I think.
Right. So Matt, just for our understanding, so that this is tracking business and consumer confidence. This is tracking.
Yeah, it's a measure of 10 different economic indicators: business, consumers, unemployment.
So these are all the things that we basically go back to and say, if fundamentals are strong, then it's appropriate to stay invested and stay the course again, because we're not seeing any. I mean, we'll talk about some threats, but
right.
The fundamentals from an economic perspective are good.
Right, absolutely. And this is a kind of a heat map chart here of global PMI, Purchasing Managers Index, and what this is showing is back in 2016 here, where it's yellow and even red in certain cases, that reading under 50 is yellow, which means that the purchasing managers, or basically manufacturing activity across the globe, was slowing. So the economy, the corporations were slowing their spending. It was just kind of a slower economic environments. Fast forward that 1 year into 2017, and especially towards the end of 2017, across the globe now, not even just pockets, but across the globe, we are pretty much all green and getting some readings in the 60s as far as Europe area, developing markets, emerging markets. That's been the story that when we're following the economic news and we're following the economic data and the markets, it's the coordinated global growth story. Everyone's moving in the right direction at the right time, and that's what's really lifted markets. As we saw in the 2017 returns, we saw that lifting markets across the globe last year, and again, we expect that to continue in 2018. So we put up some Wall Street forecasts here. These are out before December 2018. What are some of the big investment banks on Wall Street saying about 2018? We have Goldman Sachs. The S&P 500 right now is about 2,700 level. Goldman Sachs is about 2850. We have most people, I would say on average here, is about that 2850, 2900 range, which is about 7% or so of return for the S&P 500 in 2017. It's kind of funny that since January is so fast and so positive, some of these guys came out with even higher projections for the global markets and the S&P 500 in 2018. But
they didn't anticipate this week, and so
right. It's like, I know we don't put a lot of stock in predictions, and Ben can.
We absolutely don't put stock in predictions, but I find it interesting. The barest person in this listing is Tobias Lefkovich.
Tobias, yeah.
Of course, there is no relation. It's his first name instead of last name.
But your picture is missing here.
But our prediction is steady as she goes.
Right. Okay, so one of the questions we often get is, well, this economic cycle has lasted for so long. It's got to come to an end sometime soon, and it comes down to that. Bull markets don't end due to length. So two things I want to point out on this chart. On the right side, where it's highlighted as 2017, is this recovery right now. So in quarters, compared to other expansions, we're on the 34th month, and so the top end duration is 37, 36. So the expansion does continue on for the remainder of the year. It would be a new record for the duration of the global or the U.S. economic expansion, which some would argue maybe we're getting to the late stages of that. But what I would really want to point out is that we've been slow and steady wins the race on this side of the graph. These are the performance by the expansion, and the 2017 is actually the lowest. So what I'm showing here is it's been a long expansion, but it hasn't been that robust. It's been just kind of slow and steady. We're getting these 2% readings on GDP as we go forward. And so who's to say that we can't just slow growth for another 5 years? I mean, we're not quite sure, but it's not that the economy looks so overheated that it has to slow down. And so I really kind of like this chart to say, yeah, it's been a long ride, but the growth has kind of been subdued. Going along that theme is, what about the valuation of the market? We've had such a long bull market. Aren't the valuation stretch? Isn't the U.S. stock market expensive? And this is one of our major themes here for 2018, is that if you look here on some forward price to earnings ratio, which is kind of a gauge, what we use to gauge how expensive the market is compared to where the price is, to where corporate earnings are. On a 20-year average, the U.S. price to earnings ratio is 16, and right now we're at 18.2. So not, if you're just looking, it is more expensive on the more expensive side, but the readings aren't obscene. We're looking at a forward-looking price to earnings ratio, where we're seeing the value, and here's the theme, is when you're looking at all the countries of the world minus the United States, on average, a forward-looking PE is at 14.5, whereas the price to earnings reading right now is 14.3. And what we're saying here is that when we look across the globe, there might be more value in keeping your international allocation and perhaps even moving some funds to the international markets as well.
In the long run, you would expect that international will do better than domestic just because of this, because it's almost a catch-up type thing. Also, along the other side, because of the lower PE ratios, there's less value in the international equities markets this turn. So if there is a true downturn, there should be less to lose overseas.
That's a good point.
Very good point.
So this kind of answers the question that we keep getting from a lot of our clients, is because we do tend to have a bigger tilt towards value. This kind of shows us that in the long run, and this is why we're kind of holding steady on that approach, is that if you look at the number or the historical trend on value outperforming growth, you'll see that in a 15-year look-back period, value outperformed growth 95% of the time. And just to maybe give folks a little bit of a kind of insight on what does that mean, what is value versus growth. So if you're looking at value, we describe as sort of the blue chips, the bluest blue of the blue chips. These are your dividend-paying companies. To give examples, some IBMs, AT&Ts. These are your value stocks. Versus a growth would be something like a Tesla. So it's not dividend paying, but the prospects that there's going to be, significant growth and profitability in the future, these would be your sort of your growthy stocks. So this is kind of, in our minds, solidifies that, our approach is sound, in that we do believe that value will, in the long run, outpace growth. And so we're going to kind of hold steady on that within our portfolios. Ben, I don't know if you want to add. I mean, kind of seeing this play out historically.
We've seen it before, over and over again. I go back to the late 90s again. Everyone was saying value's dead, growth is the way of the future. And we stuck to our guns, and always consistently since this firm was founded, we always had a tilt to value. And in the long run, it has worked. In the short run, there are periods where growth way outperforms, but in the long run, it's almost kind of law of physics, if you will. I think it will always continue under the systems that we have. That's why we stick to it.
Okay, so interest rates. Interest rates are, fixed income part of the portfolio. Interest rates, this is a chart of the U.S. Treasuries, and this is really, in my opinion, what's really got the markets kind of riled up here in the last week or so, is that the 10-year Treasury here, this is going back to 2012 and 2016, all the way back to 2010, but you can see the lows. In the 10-year U.S. Treasury note, we had a low of 1.39 in 2012 and a low of 1.36 in mid-2016. Since that midpoint of 2016, we're actually, in the recent weeks, we're actually up to 2.8% on the 10-year Treasury. That's a significant jump in just about a year and a half. And that we kind of broke out of a pattern there in the interest rate world, where it's looking like the economics are good, and you're getting these good announcements from corporations and governments about the forecast of what's been happening in the economy. So the bond market's taking that information, and now we're seeing some of the interest rates rise. On top of that, we have a new Fed fund chairperson, so we're not sure, the markets aren't quite sure what that means as far as the pace of interest rate increases. The general forecast is for the U.S. to raise about 3 times this year, but we're seeing kind of the bond market almost look like it might start returning back to normal. We got a long way to go, but we've seen historically low rates in the previous years, and I think we're coming off those lows, and we might not see those again for quite some time.
And and if you think back, 2016, right? People weren't finding those yields in the bond world. So what did they have to do? Is everyone had to flee to equity, right? To try to get some yield on their money. So what's happening now is that as this thing starts turning around, all of a sudden investors who maybe want to take some of that risk off the table are now flocking to the bond sector, where now they could get some yield as opposed to close to nothing, which has been what we've been seeing in the past couple of years.
This is just another chart that kind of explains that. So not only are interest rates increasing by the Federal Reserve, but also on this left hand of the chart, central banks around the world have been purchasing bonds in an attempt to kind of fuel the economy globally, and they've been supporting the bond markets by purchasing bonds to keep interest rate low and helping corporations and the consumer get back on their feet after the great global recession. And so what is expected now, the U.S. has already started this, is to cut down the amount of purchases of support of the bond market. Europe is scheduled to pull back on some of their bond buying later this year, and some of the other major central banks are also thinking about pulling back some support. So they're going to try to withdraw their kind of government backbone support here of the interest rate world, and as they do that, markets might get a little jittery and more volatile. And so we're going to see, I think, this year, as unfortunately, hopefully not to the magnitude as we saw on Monday, but we're going to see some volatility in the markets as interest rates kind of come back to a more normalized level relative to 10, 20 years ago. Bitcoin.
We had to put it in there based on our frequently asked questions.
Right. So we could probably have a separate half hour to an hour seminar on what is Bitcoin and what it is and what it's not. So just a very quick high level synopsis or summary is that Bitcoin is one of over 1,000 digital currencies that we know about today. And the idea of picking just one to invest in is kind of like the tech market. I kind of think about back to the 90s when tech and the internet sensation, the tech bubble was with us. There's a lot of money pouring into these new technologies where no one's really quite sure who's going to be the winner and losers, where there might be regulation. So there is a Bitcoin or digital currency, but what's behind that is something called the blockchain. The blockchain is the technology that accounts for and develops the Bitcoin. And again, it's a new technology. We're not sure how it's going to play out over and what kind of uses it might be for corporations and maybe governments across the globe. But right now, we're kind of thinking on some major points here of what Bitcoin is today. And it's fascinating to see some of the headlines where just in December, Bitcoin was trading at $20,000 US, and today, I haven't looked recently, but last week or so I was under $10,000. So in 4 weeks, you lost 50% of your investment if you decide to dive into this thing in December.
And we have to remember what it was supposed to be was a currency, and it's been turned into an investment of sorts. Kind of like we talk about the bubble or not bubble, but when you really think of any type of investment, it has to have a value that's going to be returning to you at some point in the future. Whenever you see prices skyrocket the way prices have skyrocketed, unless a company is developing some very new technology that's going to really make a difference going forward, it's just a bubble. And I think that's what we're seeing now. And remember, even people who want to use Bitcoin are having trouble now to use Bitcoin because if they price a product in Bitcoin, they don't know how much that's going to be worth when it comes to the sale. So it's become an issue, and it's not working very well right now as a currency. With that said, there are other cryptocurrencies that are working much better.
Yeah, I think I would maybe kind of wrap this discussion on Bitcoin as, only invest what you're prepared to lose, and it's more of a kind of let's see what happens type of approach. But this is not something that we as a firm, we don't see this having a place in our clients' portfolios, at least not at this time. And Ben, I don't know if you, this is not something we're seeing that has a merit to be in our portfolio.
No, I would not suggest putting it into anybody's portfolio. This is the kind of money, if you want to invest in it, this is the same portion of your portfolio that you would go to Las Vegas and play with.
Yeah, agreed. It's a wait and see, and sometime down the road it might be a technology that we really want to dive into, but at this point it's a lot speculative and uncertainty, so we don't believe it's a good part of a balanced portfolio for the long term at this point.
And we had circulated an article on this maybe a couple of weeks ago, and if anyone wants to get a copy of that, if you didn't receive it, just let us know. We'd be happy to send that over. But it kind of just goes more in depth on the same discussion we've been having on Bitcoin.
Mm-hmm. So, Nella, Matt, Ben, this sounds like a good time to invest. The underlying economy seems to be moving in the right direction. So what could be some disruptors out there that might have a major effect on the global financial markets?
So it's interesting, looking at all the numbers, everything looks good. Everything looks like it should progress nicely. But as always, you have the unknowns, those geopolitical events. And if you take a look, we have that global disruptors that are highlighted in blue. Look at the first few items, and it's all geopolitical events that are the worries. China loses control. What that means is there's quite a few people out there that think that the government of China will not be able to continue to control its people the way it has been, and there might be a breakup, a civil war, or something like that. If that were to come to pass, be major issues. Korean conflict, same thing, continuing down the line. So it's geopolitical things that you really can't plan for. We've lived through all of those before, and as long as the system survives, we'll be fine in the long run.
Right. Capitalism is key. I would agree with what Ben noted on the geopolitical aspect too, and then also one thing that could be a disruption is if we do get that hot economic growth even faster, maybe, who knows, maybe it's not going to be 3%. Maybe all of a sudden the economy is growing at 5% and interest rates have to rise faster than what is forecast. That could be a disruptor to our economic outlook.
Right, here in the U.S., so inflation. But, there's quite a lot of things here already. So these are things that we'll obviously keep our fingers on the pulse because, one of the things we look to do is kind of stay aware of macro changes and things that would affect the way we're tilting and the way we're shifting the portfolio. So this is something that we, as portfolio managers have to be in tune to.
Right. So what should you consider as you're looking at your portfolio or you're working with us to produce an investment portfolio that will help achieve your goals? We'll kind of recap some of the things we've mentioned here. On the equity side, we do think the global coordinated growth story is still going to be prevalent throughout the world. So we want to maintain our U.S. versus international allocation. We also, we are considering even maybe moving more money or rebalancing towards international. We will be discussing that amongst ourselves here at future investment committee meetings here at Tobias Financial Advisors. But there's the home bias there. A lot of people don't feel comfortable, which I understand, of not investing across the globe. But we feel, especially this year, it's a prudent strategy to entertain. In the bond world, we would forecasting higher interest rates. We want to stay on the short side of the yield curve, focusing on bonds that mature in maybe 0 to 4 years. Higher rates mean that your bonds lose value quicker when you're on the longer end of the curve. So we want to focus on the interest rates that are maturities that are going to be closer to that near term. Another thing that we want to consider is, types of investments that are interest rate sensitive. Preferred stock comes to mind, where it's kind of a half stock, half bond type of hybrid type of investment, where when rates rise, that type of investment could get hurt. And so that would be something to look at if you're having a lot of preferred stock in your portfolio. Might be something to consider to take a look at this year. And, on the personal, we're not only we're an investment firm, but of course we're financial planners as well. If you have a variable mortgage still, or you have variable loans, this might be a perfect opportunity to look to see about locking those or changing those into a fixed rate liability, so that you're locking in what's left of these low rates before they potentially increase higher.
And then actually, even on that note, just the change in tax laws, right? I mean, you might not be seeing any tax benefit to these outstanding mortgages or loans. So it's a good time to just kind of reassess, go back and review everything. It's a good time to kind of check the financial house and see what things we can change.
In certain instances, whatever you're looking at, fixed interest rates at this point in time should be sought as opposed to variable interest rates. Even if you're doing something like a reverse mortgage, it might make sense.
So, just some couple charts here to kind of go over our investment philosophy, but also hopefully to help you remain calm. As we've seen the last week, the volatility, we had some big moves in the market. One thing I want to say, though, is, don't get wrapped up in the headlines. With the Dow at the $26,000 point mark, a 1,000-point move is substantial, but looking at it on a percentage basis, it's a lot different than a 1,000-point move even just 10 years ago. And so you got to keep that in mind when you see the headlines that Dow loses 1,000 points. It's not fun, it's not great, but you got to look at the percentage loss, not the point loss.
And so I like this chart you have up here, because I think at the end of the day, the theme is that you just, stay invested as long as, and this is kind of like a big caveat, you do have a portfolio that is diversified enough to hold through these times. If you have a portfolio that, you've kind of been playing with and just all equity, or just, kind of doing some timing and asset sector picking, this is the time to review those things and kind of get more on a globally diversified portfolio, because that portfolio will be designed to hold through these volatile times.
Absolutely.
In looking at this chart, I will say that over the course of my career, I have seen people who at times like this might get out of the market and then go back in at a later time. So it's not missing a 1 day basis, but they might miss a 3 months or 4 months. And every single time that I have seen that happen, that person later on was sorry they did it, because by the time they went back, the market was higher than it was when they went out. And it's just not a wise thing to try to time the market.
Right. And I think if anything, we've actually got a few calls from clients who did have cash on the sidelines for whatever reason, maybe sold the property, kind of just held it off on the side, thinking about what to do with it. I mean, this almost look at it as sort of a sale. This would be a perfect opportunity to start infusing that cash into the market. And when we start working with clients, one of the things that we make sure we do is that phasing in of that portfolio. And we had an example. We had a client join us just last week. All the funds came in, and we did, as usual, kind of go in a third in the beginning, which we did last week, and of course, then this week happens and the client panicked because she thought we went 100% invested her portfolio, and I said, well, no, our approach is that we phase it in just for this reason. So that's something to think about is if you've had cash on the sidelines, just think about how to get that back in the market.
So stay invested, don't overreact is a major theme here, and of course stay diversified. If you visited us in the last year or two, we've probably seen some variation of this chart. And what this is the different colors are different asset classes and what you can invest in. So 2017, if you just focus on 2017, emerging markets did 37% on the high level, and cash did less than 1%. And then this white box here, the asset allocation, which is a balanced portfolio without trading fees. This is kind of a hypothetical type of portfolio. Did somewhere around 14% for the year of 2017. When you look dating this chart back to 2003, then you just pick one color. We'll take green, that's the S&P 500, and you can kind of see the volatility, up 15%, down 37%, 2008, up 32% in 2013. So that the colorful boxes kind of jump all over the board here as you go across time. But when we try to build our balanced portfolios, which stay along these black lines, the black line here, which gives you a kind of a balanced return in all different type of market environments. And that's in a nutshell, that's our strategy to build something that is long term and not reactive to the market environments.
So we did have a question here. I think this kind of covers what we were going to cover. So we're going to see a couple of questions here. One is, do you account for the fact that growth companies move into value buckets? That is done with the platform we use, which is underlying a fund platform. And those funds are designed to look at that. In fact, specifically, Dimensional Fund Advisors is one that's constantly reassessing that versus waiting for a specific target date to rebalance that fund back to its index. So it's something that is happening frequently within our portfolios.
Absolutely.
Is there anything else there?
So,
I think that was it.
Yeah. Hopefully everyone found this an informative seminar. We're glad that you joined us today. If you do have any other additional questions, feel free to reach out to any of us here at Tobias Financial Advisors. We'd be happy to discuss the current markets, your portfolio, your financial situation in general. We look forward to our next webinar, and we'll be in touch about that soon.
Thank you. Have a great afternoon, everyone.
Enjoy and don't worry.